Let's talk a little bit more about the markets right now. Joining us for that is Joe Amato. He is President and Chief Investment Officer at Neuberger Berman. And, Joe, I was looking at your comments ahead of time. Your point is it's not when these rate cuts happen, it's the fact that they are coming. This is almost like the rate cuts are coming, the rate cuts are coming. You think of it as the British are coming, and that's the message that the markets have heard.
Sure. I think the last couple of weeks have been really important in changing the direction of travel, because we've been essentially fighting higher rates and tightening financial conditions for now a long period of time. And then when the signals shifted, I think the market realizes, okay, we're off to the races. We're now going to have a tailwind as opposed to a headwind in the context of what Fed rate policy is. So whether the first one comes in March or whether it comes in June, we can debate that.
What if it doesn't come until even later? Because Kevin Warsh was here and he said, look, the Fed may be saying this thing and predicting these things, but they don't know for certain, and things could change. It's an uncertain economy right now. If the Fed does stay higher for longer and cuts don't come until later next year or even don't come at all next year, how does that change your perspective on the markets?
Well, I think I saw Kevin's piece with you guys, and he made a lot of great points. But I think our outlook on inflation is by mid-year 24, you're going to be in the cores probably in the 3.25 type range. By year end, you're probably in the 2.5 range. So when you look at policy rates where they are today, that's reasonably tight. Now, might we be one bad data point away from a change in the narrative? I mean, that's something we all have to keep in mind. You get one bad inflation print or you get one bad Labor Department employment report, and the narrative will shift a little bit. But I think generally the direction is that rates are going to be moving lower.
When you say bad, you mean a stronger report, not a
bad
normally,
for the markets.
I would say the economy, if you look for a report that's bad for the economy, that would actually be good for the markets at this point.
I think if it shifts the narrative on what rates are going to do, I think right now the market is like we're off to the races because rates are going to be lower and risk on, if you will. But I think a big part of the story, I think, in markets in 24, in terms of what clients should be thinking about, is putting that cash to work.
Okay.
Right. You've had cash balances at significant high levels over the course of the last couple of years, appropriately so, right? Because you could earn decent levels of return on your cash, right? You were being paid not to take risk.
We kind of missed it because the markets, if you were just playing the indexes, were up pretty sharply
over
this
past year. That's a lesson to be learned, right? Which is, okay, if rates are now coming down at some point, whether it's spring, fall, or what have you, starting to move that money into whether it's longer duration fixed income or whether it's moving it into the equity markets, I think is going to be an important story for 24.
Mike Santoli just made a very interesting point, just that the stock market has gone nowhere for 2 years. So we feel like we've had this huge run. In reality, it's just a return to the levels that we had seen a couple of years ago.
Yeah, I think there was a lot of euphoria two years ago. If you think about late 21 in terms of what market levels were and what valuations were. So, but it is an important point that we're back to the levels we were before. The question in 24, I think, for equity markets is certainly the earnings outlook, but also how do the markets broaden out? We all know the story in 23 was about dispersion between the significant mega cap stocks up 75%, the rest of the market up 10, 12, whatever the number is. And then the question is, does that broaden out? Do you start to get small caps into play? We've seen small caps rally hard in November and so far in December, and catching up in that valuation discount that they've had over the course of the last 2 years.
I guess my point, though, is just the idea that anybody who thinks, things are too expensive, we've come too far too fast, we're in a much better position than we were a couple of years ago in terms of the earnings from the companies. They've made a lot of progress, so things shouldn't look as highly valued as they were a couple of years ago.
I'm not necessarily worried about valuations. I mean, again, if you segment out,
I guess I have been, but it changed my perspective.
The mega caps, in terms of the rest of the market, the valuation is pretty much average.
Mm-hmm.
If you look at the 493 stocks in the S&P 500. So I think the issue is more. We do envision the economy slowing in 24, and then the question is, what is the impact on earnings? Mm-hmm. Because if your nominal level of growth goes from 6 or 7 plus over the course of 23 to a level, if you have real growth at 2% and inflation in the 2-3 range, your nominal growth levels are low. So if you're expecting, as the market is today, 12% earnings growth, you've got to have a pretty aggressive view on margin expansion to hit 10 to 12 earnings growth, right? So we don't think earnings are going to fall off a cliff, but we think that earnings probably come down over time given the slowness or the softness that we see in the economy. Not recession, but just a slowdown from the levels we've been at in 23.
You do like small caps, though, as a result, because they haven't run quite as fast.
Yeah, and there's a huge valuation discount in small caps. I mean, if you carve out the non-earners in the Russell 2000, which represents about a third or plus of the Russell 2, valuations are in the low double digits. I mean, you're in the 10, 11, 12 range, and that's pretty cheap. And the underperformance versus large cap, as you guys have talked about, has been quite significant. So I think there is a catch-up trade there for sure.